In the first chapter, Introduction to Financial Accounting, what will we study? We will study about business, accounting for transactions, and types of business. In accounting for transactions, we will have a chance to understand more about financial accounting and the difference between financial accounting and management accounting. In financial accounting, we will have a chance to understand about financial statements. And there are 4 factors we should pay attention to. There are the main elements of financial statements, the need of in financial statements, and the users of financial information, and those charged with governance, who prepare the financial statements. With types of business, we should study about sole traders, about partnerships, and limited liability companies. So now, please, we will come to each point to study more. Yes. About definitions. So now, we should understand what is financial accounting. Financial accounting is a specific branch of accounting involving record-to-report process. It is called R2R of recording financial data. And financial reporting is a way of recording, analyzing, and summarizing financial data. So we should pay attention to the screen, and I will analyze for you. Record-to-report process. R2R. The first R, actual transactions are recorded in books of prompt entry. The transactions are analyzed in the books of prompt entry, and the totals are posted to the ledger accounts. The transactions are summarized in the trial balance. And the second R, numerous statistics and key performance indicators are reported in financial statements. And now we will come to the definition of financial accounting and management accounting. This table will give us the chance to compare the difference between financial accounting and management accounting via some criteria. The first is the definition. Yes, financial accounting is a specific branch of accounting involving record-to-report process of recording financial data. But management accounting, management system that analyzes data to provide information as a basis of managerial action. Yes, so how's about the purpose of each accounting? Financial accounting is reporting the financial performance and position of a business. Meanwhile, management accounting has the purpose of decision-making and planning for the future. And how's about the requirement? Financial accounting is mandatory, but management accounting is optional. About primary uses, financial accounting is for external, but management accounting is for internal. And how's about regulations? GAAP, IFRS, and IAS are all the regulations used in financial accounting, but for management accounting, we need no regulation here. And about frequency, financial accounting is performed quarterly, annual, or per period. Meanwhile, management accounting is as needed and ongoing. And for external review of financial accounting, maybe auditors, regulars, but management accounting, no external review here. So that you can understand the main differences via different criteria between financial accounting and management accounting. So now we will come to the financial statements. In this section, financial statements, we will come to 5 main financial statements. There are statements of financial positions, statements of comprehensive income, statement of cash flows, and statements of changes in equity. And the last but not least is the notes to financial statements. And now we will go straight to the statements of financial positions in abbreviation of SOFB. The statements of financial positions is simply a list of all the assets owned and all the liabilities owed by a business as at a particular date. The statements of financial positions includes 3 components: assets, equity, and liabilities. So now I will define for you each of them. An assets is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. And there are 2 types of assets. There are non-current assets and the current assets. And how about equity? Equity is the residual interest in the assets of the entity after deducting all its liabilities. And how about liabilities? A liability is a present obligation of the entity to transfer an economic resource as a result of past events. There are also 2 types of liabilities. The first is non-current assets, non-current liabilities, and the second is current liabilities. And now, look at your screen and you can see it's the framework. I mean the sample of statement of financial position here. And you can see that there are 3 main factors: assets with non-current and current assets, equity, and liabilities with non-current liabilities and current liabilities. So now we will come to the statement of comprehensive income. A statement of comprehensive income is a record of income generated and expenditure incurred over a given period, known as statement of profit or loss and other comprehensive income. SOPLOCI. There are 2 components included in SOCI, is income and expenses. Income is increases in assets or decreases in liabilities that results in increases in equity other than those relating to contributions from holders of equity claims. And how about expenses? Expenses is defined. Expenses are decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. So you can see very clearly about the definition of income and expenses. Yeah, and it is based on the conceptual framework for financial reporting 2018, paragraph 4.68. And now we will have a chance to look on the screen about the sample. I mean the SOCR. And as you can see here, the sale revenue is the first item in any statements of comprehensive income. And then the cost of goods sold. And when we use sale revenue minus cost of goods sold, we will have the gross profit. Yes, and then some other items such as the distribution costs, administrative and selling expenses. Yeah, after we deduct the distribution costs and administrative and selling expense, we will come to operating profit. And then we will minus finance cost. Yeah, to come to profit before tax. And then we will deduct the income tax to get the profit for the year. And also in this statement, you can see that other comprehensive income, such as revaluation surplus, will incur here. Yes, and then we will combine this in this statement, and then we will get the total comprehensive income for the year. Yes, as you can see. And the third statement we should pay attention to is the statement of cash flow. I mean the SOCF. Statements of cash flows is a financial statements which concentrate on the changes of cash and cash equivalent during the period. Cash flows must be classified as operating, investing, and financing activities. And we will come to each point to get the definition. Yes, in operating activities, the main revenue producing activities of the entity and the other activities that are not investing or financing activities. And how's about investing activities? The acquisition and disposal of long-term assets and the other investments not included in the cash equivalents and financing activities. Yes, activities that result in the changes in the size and compositions of contributed equity capital or borrowings of the entities. Yeah, so we can have a more reference, more information about SOCF in chapter 22. Yes, with IAS 7. So now we come to the next page to understand more about the statements of changes in equity. SOCIE. Statement of changes in equity is a reconciliation of the beginning and ending balances in a company's equity during the reporting period. So as you can see on your screen, it is a sample of statements of changes in equity for the year ended the 31 December 2000 year 2. Yeah, I mean, there will be some factors we will pay attention to in these statements: share capital, share premium, revaluation surplus, and retained earnings. Yes, the first thing is a balance at the beginning of the year, beginning of year 2. Yeah, and then we will add some changes in accounting policy if incurred. Yes, and then we could get the restated balance. Yeah, and as you can see, the changes in equity for year 2, maybe dividends. Yeah, total comprehensive income or issue of share capital. So when we conclude all the factors here, we will get the balance at the end of the year 2, like this. Yeah, so you can take it for reference. So now, the last but not least is notes to financial statements. Notes to financial statements disclose the detailed assumptions made by accountants when preparing a company's income statements, balance sheet, statement of changes of financial positions, or statement of retained earnings. The notes are essential to fully understanding these documents. So now we will have some example of notes to financial statements like that. The first note to the financial statements is usually a summary of the company's significant accounting policies for the use of estimates, inventories, properties and equipment, goodwill and other assets, fair value measurements, discontinued operations, recently issued accounting pronouncements, and others. And the remaining notes contain the details, including schedules of amounts for items such as inventory, accrued liabilities, income taxes, employee benefits plans, leases, business segment information, fair value measurements, derivative instruments, and hedging, stock options, commitment and contingencies, and more. Yes, and now about financial statements. We should come to the uses of financial statements and financial information. So in this section, we will have a chance to understand about the definition of a stakeholder. Who is stakeholder? A stakeholder is a party that has an interest in a company and can either affect or be affected by the business. These are two types of users of financial statements and financial informations. Yeah, there are internal stakeholders and external stakeholders. So who are internal stakeholders? Internal stakeholders are intimately associated to the organization and their objectives are likely to have a strong influence on how it is run. Example, employment, ownership, or investment. They are called the internal stakeholders. But external stakeholders have quite diverse objectives and have a varying ability to ensure that the organization meets its objectives. For example, they are lenders, tax authority, and government.